1842 Pebble Creek Drive, Cleveland, Ohio. In 2004, a woman named Denise lived here with her 3 kids. She worked 2 jobs, cleaned offices in the morning, stocked shelves at night. She'd rented her whole life, moved 4 times in 12 years because the rent kept going up and the landlords kept selling. And then one day, a broker sat across from her at a folding table in a strip mall office and said, collects more fees, the investors get a stream of monthly payments from 1,000 American homeowners, the home buyers get their houses. Everybody wins. and sold to investors somewhere in the world as a safe, reliable income stream. Surprise. Fact. In 2006, the FBI was already warning of an epidemic of mortgage fraud. The warnings were largely ignored by regulators. The people paid to tell you. It was safe. Sophisticated investors, pension funds, insurance companies, weren't stupid. They asked the obvious. Assumed house prices in Cleveland, Miami, Las Vegas, and Sacramento would not all collapse simultaneously. They did. By 2007, there were $1.3 trillion of CDOs in the global financial system. The banks creating them, the agencies rating them, and the investors buying them often couldn't fully model what was inside. That wasn't accidental. Complexity made it harder to ask uncomfortable with power wanted to say that out loud yet. September 15th, 2008. By summer 2008, the crisis had been building for 14 months. On the morning of September 15th, people who worked at Lehman Brothers arrived at their office building and found they couldn't get in. Security guards stood at the doors. HR staff handed out boxes. 26,000 people learned they no longer had jobs, some of them reading the news on their dollars to bail out AIG. Not to save AIG, to save the banks that AIG had insured. $13 billion of that went directly to Goldman Sachs. At 100 cents on the dollar, full payment. Not a negotiated haircut. Full payment on the day for the full value of insurance contracts that Goldman would have received pennies on if AIG had been allowed to fail naturally. Henry Paulson, the Treasury Secretary who made that call, later. Surprise fact. At the height of the crisis, the Federal Reserve was lending money to foreign banks, including banks in France, Germany, and Britain, at near zero interest rates through programs that were not publicly disclosed. Deutsche Bank received $354 billion, Barclays received $232 billion. Source: Bloomberg News FOIA investigation, November 2011. The bonuses. 2 months after the government committed hundreds of billions to prevent the system from destroying itself, Wall Street paid bonuses. Merrill Lynch, down $27 billion, rescued by Bank of America with government support, paid $3.6 billion in bonuses. $121 million went to just 4 executives. Citigroup, with $45 billion in TARP money, paid $5.3 billion in bonuses. Goldman Sachs set aside $6.85 billion for year-end compensation. When asked to justify it, the executives said they needed to retain talent. The talent that had just required the largest government bailout in financial history to stop from ending the global economy. The Obama administration expressed frustration. Congress held hearings. Executives apologized briefly and without visible distress. The bonuses were paid. Nobody went to prison. What took place in the years before 2008 involved conduct that lawyers, prosecutors, and the bank's own internal documents described as fraud. Mortgage originators who documented loans they knew were false, rating agencies that privately called products terrible while stamping them A or A, banks that sold securities to clients while betting against those same securities internally. Eileen, retired teacher. Detroit Eileen taught 3rd grade for 31 years. She was 62 in 2008. Her pension, the Detroit Public School pension, had invested a portion of its funds in mortgage-backed securities rated AAA by Moody's. When the securities defaulted, the pension fund lost $43 million. Eileen did not know this until she was told her monthly pension payment would be reduced. She had never heard of a mortgage-backed security. She hadn't bought one. A fund manager she never met had bought them on her behalf, based on ratings given by analysts who knew they were wrong. Nobody called Eileen to apologize. Nobody was charged. Goldman Sachs settled with the SEC for $550 million, a record, but less than 2 weeks of profits, over the Abacus CDO designed to fail. Goldman neither admitted nor denied wrongdoing. JP Morgan settled with the Department of Justice for $13 billion over mortgage fraud. JP Morgan neither admitted nor denied wrongdoing. One banker went to prison. A mid-level Credit Suisse executive named Kareem Sarageldin, convicted of hiding mortgage losses. One person, out of the thousands who designed the system, sold it, rated it, insured it, and walked away wealthy while it collapsed onto everyone else. One, who actually paid 9 million families moving trucks on streets that had never had moving trucks, foreclosure notices taped to front doors, bright yellow or orange, visible from the road, lawns going unmowed because the people who mowed them were gone, whole cul-de-sacs going quiet. 9 million American families lost their homes between 2008 and 2014. 9 million. Some had borrowed recklessly. Some stretched too far. The crisis had many participants, but many, probably most, were people who had been systematically misled by a chain of incentivized actors who were never going to bear the consequences of the product they were selling. The Obama administration launched HAMP, the Home Affordable Modification Program, with $75 billion to help struggling homeowners renegotiate their loans. Of that $75 billion, approximately $9 billion was actually dispersed. The program was poorly designed, administered with inadequate oversight, and actively resisted by banks that found it more profitable to foreclose than to modify. The official government watchdog found HAMP helped roughly 20% of the homeowners it was designed for. Cachauas, Phoenix. Carlos had been sending money home to his mother in Oaxaca every month for 7 years. He worked construction in Phoenix, framing houses that were being built faster than anyone could sell them. In October 2008, his site shut down. No warning. Padlock on the gate one morning. He found occasional work for a few months, then nothing. The remittance stopped. His mother had been paying for his younger sister's school fees with that money. In Mexico, remittances from the United States fell 16% in 2009. For millions of Mexican families, that money was the primary household income. It fell because American workers in construction and service industries lost their jobs when those industries collapsed. They had nothing to do with mortgage-backed securities. They suffered because they were attached to an economy that had just detonated. Than anyone intended. They learned, if you are large enough, interconnected enough, systemically important enough, you will not be allowed to fail. The downside of risk-taking gets passed to taxpayers. The upside stays with you. Economists call this moral hazard. When someone else coincidence. It is the predictable, documented outcome of a system in which financial institutions had sufficient political power to shape the terms of their own rescue, and insufficient accountability to bear the consequences of their own choices. The 2008 financial crisis was not a natural disaster. It was the result of specific decisions made by specific people to lend recklessly, to rate dishonestly, to sell deceptively, to regulate inadequately, and to rescue selectively. Understanding those decisions, who made them, who benefited, who had the power to make different ones, is the beginning of understanding how to prevent the next version of this story. That is what we are here to do. If this video gave you the real story of 2008, not the official version, not the sanitized version, that is historic finance. Subscribe now. Turn on notifications. And send this to someone who deserves to know what actually happened. Every financial crisis has a human story behind the numbers. Our job is to find it. I'll see you in the next one.